and gentlemen. Welcome to yet another Mayberry Investor Forum. Today we'll be bringing a briefing on our performance for the first quarter ended March 31st, 2021. I'm your host, Dan Teok, Senior Vice President of Investment Banking here at Mayberry Investments Limited. I'm sure you're now familiar with our fellow panelists. Today we'll be joined by our CEO, Mr. Gary Parrott. Welcome, Gary. And our chairman, Christopher Berry, will be joining us online later on in the program. So be sure to stick around to the end of the program where we'd love to hear some of your questions. Also, if you're interested in gaining financial knowledge, then this is a place to be every Wednesday at 6 p.m. to subscribe to our YouTube channel, and be sure to turn on your post and story notifications on Instagram to stay up to date with our streams. Before we get started, I'd like to remind you that if you're looking to expand your investment portfolio or embark on your very first investment journey, Mayberry can place you on track to financial freedom. A good start would be to follow us on social media at Mayberry INV Jamaica. Great. Now it's time to get into today's presentation on Mayberry's Q1 financial results for 2022. Okay, up on your screen, and welcome, Gary. Are you hearing us? Just want to make sure.
Yes, I am, Dan.
Okay.
Happy to be here.
Thanks for joining us again. And folks, as I said, our chairman, Christopher Berry, will be joining us at some point in time throughout the program. But getting right into it, let's look at the financial results for the first quarter ended March 31, 2022. And I recall specifically asking chairman, do they think they can do better in 2022 compared to 2021? And here we are looking at, first up, total comprehensive income for Q1 improving by $998 million compared to the same period last year. We also see a 309% growth in the earnings per share, going up to 0.58 cents for the quarter. Additionally, we see total assets growing by 28%, now up to $45 billion compared to the same period last year. And we see total shareholders' equity growing by a whopping 26%, now up to $17.3 billion. And lastly, you can see how the net book value also per share has grown substantially by 26%, now up to $14.32. So impressive growth in all of the key metrics in the past year. Next slide. This shows the actual results for the quarter compared to the same quarter last year. And here we see net income growing to $1.57 billion, 726% growth over the same period last year. That flows straight through to the net profit of $1 billion compared to net loss last year of $513 million. And we see total comprehensive income growing to $1.5 billion for the quarter. And as I mentioned earlier, this translates into an earnings per share of 58 cents for the quarter. Now, this compares very favorable to the full year results we just explained to you guys, where we did $2 billion profit attributable to shareholders for the entire year, which was our EPS of $1.72 for the entire year. So we already see in the first quarter alone, whopping 58 cents EPS, which compared to last year's full year, still represents over 35% growth. So there's our answer to, do we think the 2022 results are going to do better than 2021? Next slide. This gives us a feel, again, focused on the quarterly performance, Q1 2022 to Q 2021, how we've improved on net profit, overall net profit attributable to shareholders, and then the total comprehensive income. Those are your three bars in blue, light blue, and green. Next slide. This shows how operating expenses overall have been contracting relative to the profitability of the business. You can see that's moving in good direction there. Next slide. This shows, again, the financial highlights of the balance sheet. And again, the fact that total assets are now up to $45.7 billion, a 28% increase over the same period last year, and still a 10% increase even from the full year end, December, where we closed at approximately $42 billion. So the business is still growing in terms of total assets, in terms of total shareholders' equity, up to $17.2 billion in equity attributable to shareholders, and that's a book value of $14.32, 25.7% improvement over same period last year. So again, very impressive results there. Next slide shows in graphical format how total assets have been growing and total shareholders' equity as well too, while keeping the liabilities relatively flat, which is what you want to do. Again, total assets up to $45.7 billion. Again, very impressive growth, 28% in the last year, and 10% just in this quarter alone from where we closed the audited financial statements. Next slide. This gives you a feel for sort of the key metrics, and this is what I, as a financial analyst, I'm always very keen to look at the EPS of the businesses we're analyzing, their stock price, where the stock price closed yesterday, I think it was up to $12.46. We've got trailing EPS of $2.57, and that translates into a price earnings ratio of $4.85. So share price divided by the EPS, that's your PE multiple, 485 for Mayberry Investments Limited. In a market where, main market where I like to think of the average PE ratio of being 14 times. So Mayberry is less than 5 times, a third of where it should be from a PE perspective. And then sometimes we balance that off looking at the price to book, where again, on average in the financial sector space, I would expect to see a price to book of between 1.5 to 1.7 times. Mayberry is actually trading at a discount, one of only 2 other financial sector companies that are trading at a discount to book. And again, that shows you that there's a great value opportunity to buy this stock. When you look at something like NCB, and NCB's been trading a little bit weak of late, good earnings results recently came out, but still, NCB is trading at 14.75 times on a PE basis and 1.77 times on a book basis. JMB, again, another stock we keep saying we think is undervalued, certainly from a PE perspective. They're trading at a PE of 7.55 times and a price to book of 1.4 times. So from a book basis, you know, not so undervalued, still could be at 1.7 times comfortably, but from a PE perspective, almost half the market. And again, it makes no sense to me why you have a JMB or an MIL trading at such a substantial discount to market. Next slide, but again, I think as we keep turning out the results, I think people are going to start to appreciate it and get wise to it and appreciate what's going on. And so this green slide shows where the price to book value, or the book value per share, I beg your pardon, how that dipped in Q1 2020 at the onset of the pandemic. It fell from $11.79 down to $8. And you can see how we've been building up the book value, growing the asset base of the business substantially since then. And you can see the trajectory of that curve now from 803 Q1 2020 to 1139 by Q1 2021 to now 1432 Q1 2022. And there's nothing to suggest that this trajectory will not continue, folks. I expect that we're going to come back in 6-9 months by the end of the year and see that 1432 up to $18. That's what I fully expect as an analyst looking at this thing. Meantime, we see where the share price has not followed that curve, took a little dip in Q1 2020, and it's been slightly flat. So we're definitely expecting to see more in the months coming up. Next slide. This again sort of is where we, again using PE and price to book, sort of show where we think the share price should end up if it follows true to the market's typical multiples, which are primarily PE. So once again, you can see where the share price has up to yesterday jumped to 11.25, but again, you know, that's what's giving you this ridiculously low PE. If that were to really flex to 14 times PE or any kind of reasonable price to book, then we would expect that share price to be up at $41.63 to a low of $38.42. So it's easily, you know, 1/3, 1/4 of where it should be. And I think as the company keeps putting out consistent results, keeps growing its asset base, keeps growing in profitability, eventually the market's going to appreciate this. In the meantime, for those of you who are wise, go out and get the stock as quickly as you can, because eventually this is going to correct. It may take 6 months, 9 months, a year, I can't say, but eventually I expect this to correct, and for folks to recognize which stocks are relatively cheap, i.e. they're trading below the market average of 14 times, and which stocks are relatively expensive. They're trading substantially above that particular PE ratio. And I think just the supply and demand dynamics and good business sense will have those things sort of adjusting, especially in a marketplace where we see interest rates rising generally, and that's expected to cause some of the higher PE type stocks to potentially pull back. And I think that's it. Next slide. Okay, nope, one that tracks the share price. So again, it sort of shows how the share price has been made a dip at the beginning of the pandemic. It's been relatively flat. We've just seen a little bit of movement in recent months as the market starts to recognize the value of the stock somewhat. But I really do expect to see this, by the time we come back in 6 months, that graph will need to be extended to at least $18, $20 to accommodate that expected growth in the share price. And I believe that's it. Can't end without showing the dividends. Again, we showed this last week, Friday, the strong dividend paying potential of the business, having paid $3.4 billion in dividends since IPOing, $405 million of dividends in 2021 alone. So there is more to come in 2022, folks, because you just saw the first quarter results. So we're expecting some good dividends to be declared in 2022. 2021 average dividend paid was 32 cents. And the final slide that follows is the one that sort of tracks the share price of the stock. Next slide, guys. It tracks the share price of the stock in terms of the NAV, and we mentioned the NAV getting up to $12.77 at December 2021. And if this graph were extended to Q1 2022, that $12.77 in the blue line would now be up to $14.32. And then the green line sort of shows the net book value plus the cumulative dividends, which is up to $15 as at December. And again, if you were to extend that to Q1 2022, that would now need to be approximately $17.33. So again, we're seeing this curve moving in the right direction. We're creating value for our shareholders in driving up the NAV consistently and then paying good dividends on top of that. It's just a matter of time before the share price now catches up with that. But for those of you who got the stock cheap at $5, you'd be pretty happy now in terms of just what you've earned back from in terms of cumulative dividends, plus the value that's still sitting there. Great, so I think that's it in terms of the presentation. In summary, really great results, fantastic. I mean, after seeing the 2021 $2 billion net profit attributable to shareholders, I really didn't expect to come back and see $1.5 billion in the first quarter alone in terms of comprehensive income, and $691 million in Q1 alone. I mean, if you were to take that run rate, Mr. Parrott, that would suggest that you could potentially do $3 billion this year compared to $2 billion last year. I mean, this has been a great first quarter results. I read through the interim results, and I could see 2 or 3 areas where you're doing substantially better. One is your trading gains on your bond portfolio management, and then of course the fair value gains on the equity portfolio. What's going on down there at Mayberry Investments, Mr. Parrott? What are you guys doing to keep these results, just banging?
Well, good night, Dan. Night all. We've just focused on the customer, and I think what you're seeing is, the economy is coming back after a rough 2 years with COVID. It is showing in the equities market for certain companies. We saw that for 2021. We see bleeding over into 2022. And, whilst you see some headwinds down the road for certain companies, for others, there's a lot more gas left in the tank for those companies. In terms of our core business, your area, Dan, there's a lot to come. We did Edifocal, the IPO for Edifocal. And we've brought Edifocal through our pipeline. We started off private equity, done a lot of advisory, garden, and now we've gone public of the company. And then also we have debt and potential equity opportunities for that company down the road. We have several other IPOs in the pipeline, and other debt raises in the pipeline. And I think that again is a consequence of people coming out of COVID, and so there's a lot of companies that are going to need to refinance debt. A lot of them have taken on very expensive debt during COVID, and they're going to need to refinance that. So even with the increase in interest rates, there's still opportunities there for companies to get better structure to their capital stack. And I think we will do well there, and we have done well in the last quarter there. We've managed to contain our costs, and the areas of cost that is kind of elevated is what we don't mind at this point, which is digitizing our business. And we're way down the track in digitizing. We expect by the end of June we should be about 80 to 90% fully digital, and I think that's where tremendous growth is going to come from in our business, because we can now consider ourselves a regional company and set the stage to be a global company because of digitization. So you don't have to be physically in certain locations. Once you're at a computer, once you can press send and move your monies via RTGS, your funds can be at Mayberry. And then it's a telephone call going the next direction in terms of, the advice. And as you know, Dan, one of the things that the customers are excited about is our new app. I think it's one of the best apps out there. There's some glitches that we're working out, but we have now designed an app where it's not only just your statement that you can look on there. You can conduct transactions. You can do equity transactions. You're going to be able to do foreign exchange transactions, and we continue to make that available to the customers. And the feedback that we have got has been very, very positive. So I think once our customer base, both existing and new, starts to understand that, I mean, Mayberry is really increasing the game relative to our competition. And I think we'll get significant benefits from that going down the road. As I indicated to you when we did the interview on the audit, Dan, most people think that MJE is Mayberry and some think SVL is MJE. But the fact of the matter is that there's significantly more things that we're doing, especially at the Mayberry level, that is outside of those key things that people look on, and it shows in the results. So in a weird way, SGL had its first $1 billion quarter. This is not the first time Mayberry is making $1 billion. And if you look at the results for last year, Mayberry actually made more money than SVL. MJE is doing pretty well, but again, when you bring the big daddy into it, which is Mayberry, it's doing better than those entities. And we expect that to continue. We look forward to the growth in our managed business. We manage debt and equity for customers, and we've seen growth in that side of the business. And there's a side of our business that is still one of the better underperforming. If you look on the balance sheet, we're about $40-45 billion on the balance sheet. And the total equity in the company is $20 billion. So the leverage in the business is about 2.5 times, which is very low for a security dealer. When you compare it to other security dealers out there, a dealer is normally between 7 to 10 times. So there's significant opportunity for Mayberry to grow its balance sheet assets. It's just that we're in a very conservative mode. We're coming out of COVID, that's one. Two, we're always pretty suspicious of how long interest rates stay at these low levels. We see interest rates rising now, so we weren't as aggressive on deals before. I think we get to have a better feel for where interest rates are going to go. And I think it's putting a Mayberry in a position where we can take more deals onto our balance sheet and start to become more aggressive on certain deals, because we see interest rates rising to a level where after that, we don't expect it to go much higher. So as we have discussed, Dan, maybe we see rates increasing marginally over the next year to 18 months. But certainly, if rates continue to increase in the U.S., we're gonna flirt with recession, and in a recession, you're gonna see the interest rates come back down. So it might very well mean that this is a very good time to put assets on your balance sheet, because if you can get assets on your balance sheet at a higher interest rates, and then interest rates come down, you'll make significant gains from that perspective. So I think that's a huge opportunity that's out there awaiting us. Our foreign exchange business continues to do well. That team, has found a way to continue to eke out some really, really good benefits. Our primary dealer business, we're one of the top primary dealers out there. So all our lines of businesses have started to come on and started to do well. And we expect certainly with the digitization being complete, our cost efficiencies will be one of the best, if not the leanest, in the industry. And we will certainly want to be in that position for 2023. We might start to benefit from that to the back end of 2022. But certainly, once we've resolved that cost issue internally, then it's all hands on deck. It's just that everybody will be selling, and who's to know? Maybe next year this time we're looking at $2 billion quarters every quarter.
I appreciate that. So, folks, please feel free to send in your questions if you have any, and we'll try to address as many as we can in the upcoming minutes. So, Mr. Berry, Mr. Parrott, one of the things that also comes to my mind when we think of the high interest rate regime is, we may see more folks appreciating the value of going public, of accessing capital through the equity market, because the cost of financing through debt is becoming increasingly more expensive. And I can say we have at least 4 or 5 companies in the pipeline now that we're working with for future IPOs. But could you give some words of encouragement to folks who are shy about accessing capital through the equities markets? I talk to a lot of folks, and they often say to me, I don't want people to know my business. I don't want them to see my results. And they shy away from going public because they somehow think, the world's going to be up in their business. Could you give a few words of encouragement as to, why folks should think about going public and accessing capital through that means?
Sure. It's one of the reasons. I mean, even after our pretty subdued, performance or results in the IPO market for 2020 and 2021, the fact of the matter is that we still hold a record for the most amount of companies listed. And one of the prime things we say to our potential investors is that the biggest asset you have in a company is the shares you have in a company. But when you're private, you can't monetize those shares. When you become public, you can take loans against them because you can value them readily because you have a public exchange that values your shares. And as you're aware, Dan, in accounting, you have level 1, level 2, and level 3 pricing, with level 1 being the most transparent, which is what you have on a stock exchange. So when you have a private company, you have to contract people at a certain point in time to determine what your pricing and the values for your businesses are. And it's very complex, complicated, and expensive, and it's not necessarily correct in terms of, how many people out there would be willing to do a transaction for that. But so once you're listed, you have a place where everyday people are willing to buy and sell your shares, and they set the price for your company every day. And, that's something that allows you to make other decisions, So just like you have your house or several houses, you might decide to take a mortgage against it, use the debt, buy another house until your cash flow picks up and car catches up, and you pay them out and you go down the road because the opportunity was there. That's a huge one. The next one is the succession and retirement. A lot of companies, the shares are owned by 1 or 2 people, usually the primary owner in the company. And, in terms of creating a will, in terms of succession, it's pretty difficult to do that with private shares. And what you found is that a lot of the people who have listed, it becomes easier. They can say, okay, I have 4 kids, I'm going to cut the shares up into 4 or 5, and you split it out accordingly. And then the kids can decide, do I hold the shares and, try to work in a company, or do I sell them, get some cash, and I go about my business, And we've seen where in some families, some people sell to other family members, those family members that have pretensions to go down the road with the companies, and they start to accumulate. And those who feel like, hey, I want to go a different path, they get their cash and they go down there. So those are two key reasons I think companies out there who are considering listing should think about, because it creates a lot of value. And one of the things I say to people, we don't have to recreate certain wheels in Jamaica. So when you look on the equity market, developed countries You know, their equities market drives significant gains, funding, etc. for a lot of companies. And when you look on household companies, it's very rare that you will see the original promoter have more than 20% of a company. As a matter of fact, if they have 5, it's a lot.
Mm-hmm.
You know, when you think about the Facebooks, the Microsofts, the Ford companies, you know, those original guys, Gates, those guys, they don't own more than 20% of the company. You know, I think in recent time, Elon Musk might be a little bit different, and he might own a little bit more. You know, but it still doesn't cross 50%. So what you're finding is that you don't need 50 plus one. Worse, you don't need 100% control of it, right? You know, and that gets us into a conversation about, you know, diversification, but we'll come back to that. So, you know, once you have the business, you definitely don't need so much equity in a business. You can diversify, use your cash, start another company, do other things, you know, and it's the way to go. You know, so this thing of trying to hold on to your idea when the business has the potential to grow 10,000 times your financial capacity. So why fight it? Bring in others who have the financial capacity and watch your idea expand into a real world company.
Absolutely. And one of my favorite things, I'm a big fan of margin, accessing equity financing. You can't do that in the private space. The minute your company goes public and you have a valuation for your shares, then
Yeah.
folks can actually access margins or loans against the traded
Right.
value of your stock portfolio. And that's just, you know, another way that just opens up great access to capital for folks. So, folks, we definitely
No,
encourage you to
and,
give
sorry, as
consideration.
you know that, you know, one of the things we promote to a niche set of customers at Mayberry is access to margin. And what we've found is that we have customers who, when opportunities come, they come to you to access margin against their shares. You give them a check within what, 2 hours, 3 hours, depending on what time of the day.
Absolutely.
Worst case, they get a check in a day, and they go and take advantage of the opportunity, and then they refinance it and pay down their margin. You know, there are few people that has that ability, and few entities that give that their customers that ability to do a lot of stuff. And as you and I have seen from our customers, it is very flexible, and it allows people to do a lot of good deals.
Absolutely. It's a multi-billion-dollar business for us. And, you
Right.
know, I'm always amazed to see, you know, clients, you know, coming in and asking for a 200, 300, $400 million margin because they want to take advantage of some opportunity out there in the market. And, you know, it's a great, you know, success story. I really like to see the, you know, forgive my language, the smaller businesses going public and then watching how they transform. And I'll give you folks one example because I know Cecil Foster from Foster's would not mind this. We've been working with them for 3 years. We've watched that company grow from $3 valuation to $23 valuation, you know, access hundreds of millions of dollars to grow the business, expand. Now they're doing PVC pipes, transformers for GPS. Now they're looking at doing a, you know, 10-to-1 stock split and raising additional capital from the market. And in the last 4 months alone, that stock price has gone from $16 to $30. So great success story how that market capitalization has gone from a start of 400 million to now over $3 billion in 4 years. And this is a great success story that awaits any wise businessman out there who's willing to run their business, you know, smartly, efficiently, have a good investment advisor like Mayberry, and just go out there and access capital to grow your business like crazy. So it's what we do at Mayberry, guys. And we encourage you to look for the opportunities to, you know, consider coming in and talking to us if you have a good business and you're considering going public to take advantage of the junior market tax break or just to access good capital. It's what we do here at Mayberry Investments Limited. Great. So first question I've seen is pretty interesting, comes in from Christopher Rose, who asks, why should I start an investment portfolio at Mayberry? Now, Chris, you've got many places you can go. There are lots of brokers out there, lots of folks who can give you advice. I think it's very important to start your investment journey. It doesn't have to be with Mayberry. There are other folks out there. I don't think they do it quite as well as we do. I can't think of another broker out there with a $20 billion managed portfolio that they've grown from 10 million US to 150 million US, but there are folks out there giving you advice. At Mayberry, we sort of specialize in sort of a boutique type thing. We're not trying to have a million customers, but the 3,000, 4,000, 5,000 that we do have, I think they're quite happy. And while we have $40 billion of business on balance sheet, we have over $40 billion of funds under management where we're just giving folks advice. What we do is provide advice here at Mayberry. So we don't need to hold on to your money and have it on our balance sheet. We're happy to just give you the advice so you can invest your money accordingly through us as your broker. So that's sort of one of the great things we do here at Mayberry. Next question before I give you another one, Gary, comes in from Mr. Chemical. I think it's more of a comment. This guy is very smart and underrated. I've been listening to his interview in the last few weeks, and I can see why his companies are successful. So I assume that's towards Gary Peard, and he's speaking about Mayberry Investment Limited, MJE, and Supreme Ventures, why those companies are doing so well, and I could not agree with you anymore, Mr. Chemical. So Gary, the future is bright, I think, for Mayberry Investments. We're still not completely out of the storm, though I think as a country, again, we're seeing high inflation, we're seeing high interest rates, we're seeing exchange rate coming under a bit of pressure. But on the good side, we see strong resolve and commitment from the government of Jamaica, as Chairman Berry said last week, Friday, to stay committed to trying to reduce debt. More recently, we see the trade unions, putting a little pressure on the government, asking for wage increases, and we know how that can, create a spiral effect in terms of inflation. Just at the macroeconomic level, what are your thoughts about the direction the country is going, and how will that impact how you want to maneuver, whether Mayberry or Supreme Ventures or any other businesses that you're involved with, or how your thinking is going to work over the next 9 months, 12 months to 2 years in this macroeconomic environment with the headwinds and challenges I just mentioned?
Well, sometimes, what I'll start with, people might think is Monday morning quarterbacking. I've always said to people, the days of having an accountant in your business has ended. You need to have a finance person, so your chief financial officer, CFO, that's the way forward, because the market in Jamaica moves so rapidly. You need somebody that understands not just how to account for stuff, but how to navigate the financial markets. We spoke about in the past the volatility in the foreign exchange market and what our finance people can do to turn that into something that's very positive. But where we are now over the last 2 months, we've been speaking about it. We've been speaking about the possibility of higher interest rates. We've been speaking about the possibility of devaluation, etc. And one of the things we do, we don't have the luxury, Dan, as you know, to spend a lot of time and theorize about a whole bunch of stuff, because we get paid based on results. So what we have been doing is that we've been saying to customers, now's the time to borrow, and borrow as long as possible at these interest rates, because what the opportunity to borrow at 7% and 8% for 7 years and 5 years is going to pass. And we're starting to see where the financial institutions are now looking to increase their interest rates. And we're in a position now where, as a financial institution, we're just not sure how far interest rates are going to go now. Yeah. Because when we look on the results that are coming out of the BOJ auctions, etc., we're seeing institutions paying as much as 8% for 3 months for funds, and those interest rates are likely to go higher. So a lot of institutions are not necessarily going to be lending money to businesses longer than a year, in the sense that they're not going to lend fixed. So what you'll find is that a lot of the lending is now going to start to move towards variable. So, one of the things a lot of people aren't aware of, for example, your mortgage, the majority of mortgages has a little clause embedded in there, that the mortgage company reserves the right to increase the interest rate at their behest, So, you have some people who figure that, hey, I got a mortgage at 8%. And they don't realize that if you have a sharp movement in interest rate, the mortgage company is just going to advise you, hey, we're increasing the rate on your mortgage, and this is what your new monthly payment is going to be. So that side, that hasn't dropped as yet, but it certainly is coming. based on where we see interest rates are in the short-term markets, where we see customers with a high cash balance, what the interest rates they're demanding of institutions when they shop around. And that leads me to the second recommendation. Try to get as much cash as possible. So you're now going to have to try and reduce your receivables, extend your payables, because you want to generate as much cash in your business, because with interest rates now getting higher, you can make material returns on your short-term interest, cash interest on your cash. So you have to look on basic stuff. Like in the past, it was always important, but because the rates were so low, a lot of people just didn't think that it made a lot of sense, but it makes sense now. So you go to your bankers, you need to be negotiating for interest rates on your current account if you have that ability. If you have that amount of money to be able to say to your banker, you need to have an interest on your current account. If they don't want to do it, there's some banks that actually, provide it. So you find out those banks and you move your current accounts there. It's not about emotion, it's about money. So you go where you get your best deal. Outside of that, if you don't have interest on your current account, physically move the money. Move the money into your savings account, which is higher, or ultimately move your money into a repo. One of the things people are not aware of, every commercial bank has a security dealer subsidiary. And most of those security dealers, Dan, as you know, are primary dealers of the Bank of Jamaica. So they sell instruments of the Bank of Jamaica directly to customers. And, the interest rates on those instruments are much higher than what you're getting in your current accounts or your savings accounts. But so nothing prevents you from going there. So the guy that asked earlier, why come to Mayberry? The spread we're going to take on that instrument is significantly lower than what some of our competitors do. Because again, we work in volume. So the more instruments we can buy from the BOG and sell to the customers, the better it is. So it's a win-win-win.
Absolutely.
So
And
those
if
are
you
three
have
key
excess
things.
cash out there, folks, you can also bring it to Mayberry and we can manage it for you in our
Right.
money market account. Gary, just moving along because I see the questions piling up. Sean Davidson, this is a great observation, Sean, and I'm happy you have it. He says the JSE index has actually been trending down. How does Mayberry feel about recession, and will it impact your balance sheet directly, and do you have a plan against this? So let me take the first part, Gary, and I'll let you take the second one. The JSE main index has not yet gotten to its pre-pandemic levels, so you're correct, Sean. And despite that, the MJE fund we manage has grown by over 30% in the last year. So this is exactly why you should bring your money to Mayberry, because we're outperforming the main index. That's just a simple fact. MJE has grown its portfolio substantially in the last year, despite the fact that the main market isn't back yet. Now, we've been talking about could Jamaica fall into recession is his question, Gary, and could that impact Mayberry? How could that impact your balance sheet if Jamaica were to fall into recession?
Yeah, so I take both questions. Just to add to your answer, Dan, as you said, it's an index. An index is an amalgamation of several companies. And so within that within that index, you have companies that have gone up and you have companies that has fallen, just like the majority of them have fallen. So if you have a portfolio that has more companies that have the upside potential, then it will buck the trend, for want of a better word. And as we have explained before, that's one of the reasons we at MJE had invested in Supreme Ventures, because what we find is that that's a business that does well when the country is growing, but also does well when the country's heading into recession. Because people are going to gamble whether it's in recession or whether the economy is doing well. And people might argue that they gamble more when they're in a recession. But more importantly, Supreme generates a significant amount of cash. So in a rising interest rate environment, you expect your interest income to increase from that perspective. Supreme is one of the different companies that we invest in. But the majority of companies that we invest in, we think, will buck the trend. So, for example, CPJ, which has now risen to be probably the second most valuable company in MJE, Dan, they earn the majority of their income and revenue from the tourism sector. Mm-hmm. So even when the world is in recession, we are still still getting tourists coming to Jamaica. And the fact of the matter is that we probably now have more hotel starts for 2023 than any other time in the history of Jamaica, meaning the number of hotels, Dan, that are expected to start operations next year is a ridiculously high number. So a business like CPJ, even if you go into recession, we expect them to do pretty well in the recession. So, I'm saying that yes, the index gives you an idea as to the general trend of companies across the country. But if you have selected certain companies, they will perform or outperform the index. And we think the companies that we have in our portfolio, in terms of the majority of those companies, we expect them to outperform it. Just to close, Lasker Financial is another company. What have we seen? When you head into a recession, remittances increase. So that company will benefit from that. And once your remittances increase, your foreign exchange gains from the conversion of that does well. It's also a microfinance business. So again, in a recession, the loans will increase. Yes, you'll have challenges with your bad debts, but that's where you place reliance on your credit policy and your business model, and you go down the road. So in closing, I think Mayberry is in a very good position where that's concerned. In terms of Mayberry, the business, we're a niche player, and so some of the customers we reach out to, they're in it's not that the recession will not impact them, but in terms of how we operate, in terms of providing the advice, and again, Dan, as you will know, in a recession, good companies place significantly more reliance on their advisors. So like our advisory business will do well, and we expect that to do well. We're not a big player in the overall retail commercial loan market, but we'll see where in our equity margin type market, we expect that to continue well. Now, against that backdrop, yeah, you might have some compression on multiples, PE multiples, but if you have bought into good companies, it will come back. And that's one of the things that we're not afraid of at Mayberry. We're not going to get up and sell a good position because we think over the next year, it's the stock price, they're going to misprice the stock, because at the end of the year, you're going to come back to the same position as it continues to do well, and it jumps again. And that's our philosophy. We've been investing in equities from 1985 down. You just gave the figure. We invested 10 million US in MJE, or what was MJE now. In 2006, it was worth 150 million in 2019, just before COVID. It dipped to $80 million, and guess what? It's back to 130 million US now. And you never know, by the end of this year, it might very well be 200 million.
Excellent. And Romeo Scott asked a similar question: how do we think interest rates will impact the stock market in general? I think the same way the recession could impact, similarly, interest rates could impact, PE multiples could come down, but again, the businesses that have good cash, are generating good cash flows, are the businesses that we think will do exceptionally well. I think I don't expect to see people changing their asset class of investments substantially because of the temporary trend of increasing in interest rates. In fact, I think this bull market and the appetite to continue investing in equities is only going to increase. Gary, one question from me. I know a lot of friends. I was one of them up to 5 years ago. 80% of my wealth was in US dollars, and it limited me to bonds and real estate. What do you want to say to folks who still have that mentality? The lion's share of their wealth is in US dollars. They don't want to invest in the GSC. They're more inclined to invest in the US stock market. And I have a couple of friends, I could call their names. They're getting their tails busted in the US market over the last year or two. How can we encourage more people to invest in Jamaica?
Well, the fact is this, Dan, and again, I said to people, the world of investing has changed significantly. And I think that's one of the drivers for people coming to Jamaica, because prior to 2008, when you had that credit crisis and the real estate blow up, the stock markets, for example, generally went in one direction in the US. And, since the credit crisis that you've had significant corrections, and, as we always say, Dan, a rising tide lifts all boats. So back in those days, whatever stock you invested in, it just kept rising. What we're now going to see with a pullback in the market, especially in the US market, is that, you have to really understand that market. And what has happened is that a lot of people now realize that A, they don't understand it. B, some of the advisors they had there don't understand it either. If you understand Jamaica better, if you're in a certain social strata of Jamaica, you can better understand Jamaica. And, one of the things is, when somebody says they're in the New York stock market or they're in the Jamaica stock market, these markets, is an amalgamation of companies, right? So, I prefer to say to people, not just that I'm in the Jamaican stock market, but I'm investing in a lottery company that's resilient whether the market goes up or goes down. I'm invested in a Grace Kennedy, that's a great brand that's expanding its food business globally, right? Because it changes that conversation. So if somebody's invested in a market, they'll tell you, "Hey, I'm invested in stock, the NYSE." Yeah, but which stock? Is it Berkshire Hathaway? Is it a penny stock? So that really, makes a difference, as to what you're doing. But I can tell you, I've gotten a lot of calls from the stock experts, because the U.S. market is doing stuff that a lot of people did not expect. You don't wish anybody to lose money, but one of the worst things you can do is to invest in something that you don't really understand. And I'll be the first person to tell you, Dan, that, hey, I'm not an expert in the U.S. stock market. Do I understand the basics of stock? Yes. Do I think I could be a great advisor in the U.S. stock market? Maybe. But there's still so much money to be made in the Jamaican market, and advising in the Jamaican market. Why take that on? So there's a lot of legs here. I know the people here. A lot of us know the people here, and we can get a better feel for how to invest here. And against that backdrop, why do anything else? All the people, as you said, just to close the point, Dan, a lot of people invest in US because they expect a gradual devaluation every year. This government has come in and they've changed that. They're telling you about two-way movement. And you've seen people who keep buying at the top and selling at the bottom, right? Because every time they think the dollar is going to devalue into anything, they run to buy, and then when the dollar pulls back, they're like, "Oh my God," and they suck that loss, and then they go again. So those days of converting as soon as you get J and only selling back US when you have to pay a J bill, those are done. If you don't understand the cycles in the Jamaican market, you're really not making much on the US side of things. So when we adjust for the returns in the stock market, I think we sent out an analysis the other day, Dan. I think we're doing 20-30% after you adjust for devaluation for 2021.
Yep.
2022 might end up in the same region, and that's huge.
Yeah, and that's certainly been my 5-year experience. Real practical experience when I switched from U.S. bonds where I was averaging 8.5% U.S. and I said to myself, well, I'm making 8.5% U.S. and the dollar's devaluing by.
No, but Dan, 8.5% U.S. But you ran the price risk.
Yes.
If that credit deteriorated.
Yes, absolutely. And again, I was glad because when I made the big conversion, I had a lot of Digicel bonds, by the way. And I think I was yielding 9.5% on the Digicel bonds. And I thought to myself, 8.5% US plus, 5% devaluation, what gets better than that? Until I really got serious about equities and realized that I could average 25 to 30% in Jamaican dollar equities comfortably. And that's been my 5-year trend and experience where I'm averaging, even despite the pandemic, 25 to 30% return in Jamaican. And so I'm doubling my portfolio in Jamaican dollar terms every 3 years. And that's definitely been my experience. And when you throw in some IPOs, it gets even better. So again, folks, we're really serious about, you don't have to have 80% of your wealth in US dollars. There's definitely a place to be investing as an asset class in the Jamaica Stock Exchange, in good companies, through good brokers. Doesn't have to be Mayberry. We're not saying we're the only guys who can do it, But I do really want to encourage people to break this mentality of thinking I can only invest in, U.S. equities or U.S. real estate or U.S. bonds because, if it's Jamaican, it can't be good. There's significant value and wealth to be created by investing in Jamaican dollar equities, and whether you're investing tens of millions, hundreds of millions, or billions of Jamaican dollars, it can still be done. Because some people think our market is small, you can't invest, $1 billion. And here it is, we got a $20 billion fund that's doing exceptionally well. So I want to dispel that myth to my high net worth friends out there who think like, trapping your money in US dollars is the way to go and earning 6-7%. That's not the way to go. There's nothing wrong with having US bonds as a part of your portfolio, maybe 15-20% of your portfolio. But if you don't have 30 to 40% of your money in the JSC, you're really going to be missing out on huge opportunities to come, both now and going forward. And whether you look at the numbers in the last 10 years, 15 years, or 20 years, you're still going to see that the JSC as an asset class is one of the best performing asset classes. The next closest might be real estate, but here's the big difference. You can't buy $1 million Jamaican dollars worth of real estate, but you can buy $1 million worth of equities. You can buy, $10,000 worth of equities. So again, I think equities are the best way to get going, guys. For those of you who've just started working, you must be investing early in the stock market. The sooner you get going, the better it's going to be. I remember when I could buy Carib Cement at $5. I remember when I could buy Scotia at $12 or NCB at $15. This was not that long ago, folks. And within 8-9 years, those stocks I just mentioned are up multiples of 5 to 10 times. And I regret not buying more of NCB when I could get it at $15, or Sagicor when I could get that at $20, or JMB when I can get that at $21. So that's the thing I regret the most, that the first $3 or $4 million I invested, 8-9 years ago, that I only invested $3 or $4 million when I had the capacity to do more. And now those investments are up 10 times, in 8 years. So folks, it's never too early to start investing in the market. It can always be late. And so I encourage you to get going early rather than late. So Mr. Peart, coming back to MIL, I'm really excited to look forward to the next quarter, the June quarter. We definitely have to get you back to talk about these, crazy results. You're up by 35% over last year, which was already up substantially over the year before, and the 3-4 year trend is amazing. We really are looking forward to bigger and better things from Mayberry Investments Limited. I'd like to give you any final comments that you may want to make about, again, folks who are considering about buying the Mayberry stock and wondering, should I, is it really worth it at, $8, $11? Compared to the market, this P is at less than 6 times, and the price to book is less than $1. Any final comments you'd want to make on that, Mr. Peart?
Well, what I want to say in closing is that I want to thank the team, including yourself. These results couldn't have happened without the team. We have a very young and impressive management team, including the board of directors, that allows us to achieve these things. As I indicated before, I believe a trend will continue. When you think about it, these results are to March 31st. And if you look on the pricing, for example, of a lot of the shares that are in MJE at March 31st relative to where they are today, if those prices hold to June 30, you do the math, you create that spreadsheet, and you do the math. I would say to people, these ratios, whether price to book, net book value, EPS, multiples, they're at a point in time. You need to stop and not just necessarily look on the hardcore numbers, but look behind the numbers. Is this a growing company? So a company with a high PE is not necessarily bad, if that company can maintain that growth rate. So if it can't maintain it, then hey, it's a time to sell. A company with a very, very low PE, doesn't necessarily mean that it has growth. But the flip side can be true. What it's telling you could actually be the case. It could have a low PE simply because it has been overlooked. And, there's significant upside there. As you have indicated, whether you pick it up or not, the value is there. We'll continue to build the company. It's interesting. When you mentioned the gentleman before, that he's not necessarily aware of who I am or who Mayberry is. When I have some marketing advisors saying, "Hey, I might be overexposed," it just goes to show you, there's always somebody new that doesn't necessarily know what's happening. Yeah. And I think for those people coming in and understanding brand Mayberry, it's not just a brand. There's a lot of stuff behind there. We create a lot of value for a lot of customers. Whilst people like to focus on the chairman, Chris Berry, I mean, and he's great at what he does, but the company doesn't start and end there, nor does it start and end with me or Mark. We have a lot more people, and just look at the numbers, regardless of what we're saying. We just like to give advice, because one of the greatest things for us, Dan, is to see somebody's face when they become financially independent. And so some of these advice that we're giving, like one of the best ones we like to say to people who are normally in the bond market, if you're afraid of the stock market, if you get interest, whatever your interest frequency is, let's say you get $1,000 every month, take half of it and invest in the stock market. So if you get $1,000, buy $500 worth of stock. If the stock goes to zero, you still would have earned half of your interest. So you haven't lost anything. But the probability of that stock going to zero is pretty low. So, we use that to get people to start. And I think that's where you should start. And I want to close by saying to people, we are one of the most active foreign exchange traders out there. We have one of the largest cambio businesses out there. And, come to Mayberry if you want to buy and sell some foreign exchange. In addition to which, one of the areas that generates a lot of income for us is interest income. So we have managed portfolios for our customers. Managed portfolios meaning not just equity, but fixed income bonds. And some of the returns on those portfolios exceed a lot of what the competition has out there. And, we have a boutique set of clients who are very, very happy with the returns that they're getting. And I mean, you're welcome to join them any day. And I close down, by simply saying, one of the best kept secrets, which I'm trying to put out there, is our pension management business. So, if you see what we do in MJE, can you imagine what we'll do for your pension? So we have an individual retirement pension scheme, where individuals who don't have a pension can contribute to that. Returns have been very good. And also, if you're part of a company pension scheme, we have that side of the business that takes care of it. So, those are two areas that we're pushing very, very, very seriously and significantly for the rest of the year. And we continue to see some nice growth there. So that, by Mayberry.
Thanks for that. I appreciate that. And I see two questions, just coming in. One very interesting, and I think we should respond. John Butler, Gary asked, I noticed Mayberry Investments Limited reducing its share ownership in MJE during the year. What's that about? Can we expect that you'll be reducing your position even further in the future?
So the probability of us reducing it is pretty low at this point in time. The reality is that, is that there's a good and bad to it. So the good side is that every time Mayberry sells shares in MJE, it gets capital, which is one of the reasons you see that our capital to assets is pretty low. So from a risk perspective, it reduces significant risk, especially regulatory risk for Mayberry, because we have so much capital, which we get when we sell. Obviously, the flip side to it is that when you sell, you have less of a share of the upside in terms of the profit from MJE. But the other pro and con is, we're building MJE to be a long-term, sustainable investment portfolio. And, we are approached by different strategic investors that want to take certain positions. So if you can't create liquidity for those customers, for them to get their position, the price just becomes ridiculous. Yeah. And could scare them off. And so depending on who the customers or the clients are, we will sell shares. I think where we are now, I think we have sufficient shares out there that would not necessitate any additional sales from Mayberry. I mean, that position could change, but the probability of it is, as I said, pretty low. Because as I started at the beginning of the program, I mentioned that the leverage in Mayberry is very, very low. It's almost 2 times. It's closer to 2 times than 2.5 times. So we have significant capital to grow. And I think, myself and the management team, as we get to the back end of this year, we have our job cut out for us to significantly grow that balance sheet. So if you think about it, if we have 40 billion in assets now with 20 billion effectively in capital, if we double the assets to 80 billion, it's still leverage of 4 to 1, which is for a financial institution, it's still pretty low. When you think about it, I think the commercial banks can go all the way up to 20 times. Not to say that they're going to get that close to it, but if you use 10 times as a reasonable number, at 20 billion in equity, we could basically grow to 200 billion in assets. Which, as you can imagine, if we move the balance sheet to that level, what the interest income, what the gain on sales, I mean, it'll be crazy numbers, right? But before we go there, as I've always said, we're conservatively aggressive. So we have to see that fiscal performance of the government hold. Probably if debt to GDP fall to 50% and lower, you can then say, all right, let's ramp this thing up because you have a pretty stable environment. But that's the opportunity that we face. So I conclude by saying, no, the probability of selling any more MJE shares is pretty low. But the upside to that is if we're no longer selling, if people want to get in, the only way you can get
the price will go up.
Move the price.
Excellent. Thanks for that, Mr. Peart. We really appreciate your insights into MIL and the performance during the first quarter 2021. As always, I'd like to thank our viewers for tuning in and being a part of today's investor briefing. I'd also like to thank Gary Peart himself for his profound contribution to today's discussions. We urge our viewers to follow us on social media to keep up with all things forum related. If you'd like to know when our next virtual forum will be, just tune in to social media to find out about our upcoming events. Also, I'd like to encourage you not to forget to subscribe to our YouTube channel, Mayberry Investments Limited. Keep safe, folks, and remember, wise investors, slow and steady wins the race. Goodbye.